growth manager. Hopefully by now you all understand who Hyperion is. What we're really trying to do is grow our clients' capital sustainably over the long term. We've got our missions, values and beliefs over there, but what I'll draw your attention to is the table over here on the right. And so we're running around $17 billion of funds under management. And we've gone back and had a look at where those fund flows have come from over our 20-odd year history. About 7% of it has come from net flows from our investors. 55% or thereabout is from market returns, and roughly 40% is from the alpha that we've been able to generate from our investors. It's a really, really strong track record that we're very proud to stand behind. And effectively what that means is if you gave us some money 20-odd something years ago, we've turned that $1 into about 15 bucks. So we're very proud with that, and hopefully you've joined us on the journey and we've made your clients a lot wealthier on the way. How do we do that? Again, shouldn't be too much of a surprise for you. We're investing in what we call these new world companies. They've got disruptive technologies or strategies, sustainable competitive advantages and tailwinds. There's a bit of a flavour of some of the companies down the bottom. We'll have a look at a few of them a bit later. But what are we really trying to avoid? Old world companies. These are the old world businesses, are the things that generally make up the bulk of the indexes around the world. They're your big traditional banks, your services companies, your miners, your commodities, your commoditised products, heavy industries and so on. These things don't have any real innovation about them, and they're very sensitive to economic growth. If the economy's doing well, they'll probably do okay. If the economies are slowing, like they are at the moment, they'll probably start to slow down. And what we're also trying to avoid are early stage fads, concepts, startups, momentum things. The pandemic was great, they had a heap of them. There was Peloton, brilliant. Beyond Meat, even Zoom, we're all on Teams these days. So these businesses are early and may not have a real business case to invest in. So what we're really trying to find are natural monopolies, businesses that are able to grow organically and steal market share from some of these old world incumbents. If you were lucky enough to turn up to the Pinnacle Global Insight series earlier this year, you would have heard me talk about some of the false narratives in the markets. Valuation's always too high and there's a heap of concentration sitting in markets. Another one's popped up over the last few months, which is a cracker. American exceptionalism is over. Let's have a look at that. And so we've gone back and we've had a look at the investment in the US over time. And what we've found is the US is a very, very fertile place for investment and innovation. We've had a look at R&D investment and venture capital investment across the globe. And as you can see, the US is miles ahead of the pack. And what we've come to the conclusion is that America innovates, China replicates, and the EU regulates. Boom. But what does that look like on an earnings style chart? So we've stripped out the MSCI World, our benchmark, just to the US and the rest. And as you can see, the earnings per share of the US portion of the MSCI World versus the rest is about 2.5 times greater. So there is real earnings power that is powering forward that innovation that the US has been able to generate. Then if we go and have a look at the tech side, the NASDAQ EPS index versus the MSCI World, 5.5 times greater. And so I've heard a lot over the last 6 months, domestically and globally. You show me a company in the US or even here in Australia, with a really high PE, and I'll show you one in Europe or in Asia or somewhere like that. The PE is much, much lower. Why is the PE lower? Earnings aren't there. So there's nothing wrong with paying a high PE, so long as the earnings are there to underpin that drive forward. Another interesting chart that I like to show you as well. I've had a look at the top 20 companies in the US and the top 20 companies in Europe. The top 20 companies in Europe sum to 4.4 trillion. That is an Nvidia and a Costco. So, innovation and monetization on the screen in front of you. We've also heard a lot about our orange-haired friend about tariffs, which may or may not be implemented. Not 100% sure he knows what he's doing, but I don't think any of the tariffs have actually been implemented to date. Even if they were, there's low levels of direct sensitivities in the Hyperion portfolio to tariffs. And if you are worried about some tariff uncertainty and potential inflation that may come from that, have a look at the performance of the global fund over the past 5 years. We've been able to outperform significantly over that time in a very turbulent marketplace. Bit bit more fun stuff for the portfolio. There's been a lot of changes in the portfolio over the last few months. This is a fun part, audience participation time. Hands in the air if you're from the southern beaches. Oh, only one. Come on. You might have had an interesting bit of fun with Axon's main flagship product, tasers. This worked a lot better on the Gold Coast, trust me. Axon is a really interesting business. They create a product called Taser. Really high quality product. Most police officers around the world use it, the little yellow gun in their pocket. And that's been growing at around 24% over the past 5 years. They also have the body-worn cameras, which is fantastic because the great thing about the body-worn cameras, it rolls into the software piece. And so if the police officer's had his camera on throughout the day, it's listening and watching everything that's happening. And at the end of the day, it's pre-populating the end-of-day reports for the police officer. Now, the majority of police budgets go to personnel. So if you can keep the police officer on the ground doing his job longer and take away the arduous task of writing out reports at the end of the day, there's a lot of productivity gains that we're seeing. And Axon is completely dominant around the world in both Taser, body-worn cameras, and the software piece that's plugging in underneath it. We've recently added NVIDIA. We got there, finally. We're not speculating on how many GPUs or CPUs they can sell next month, next quarter, 6 months, 1 year, or 2 year. We've actually gone to the work of building out the end markets over the next 10 years. And so we've had to build the end markets for automation in cars, robotics, data centers, inference centers, and also when those processors come out of the cloud into your handheld devices, your tablets, your laptops, your TVs, and so on. And then only from then, we could stipulate, is NVIDIA still going to be dominant? What does the competition look like over that time? And what type of price can we pay today that will still be attractive returns in 10 years' time? NVIDIA is currently selling around 5 million CPUs and GPUs. We think that could probably double over the 10-year period. So we've entered a position there. And another company you've already heard from today, Hemnet. The easiest way to think about Hemnet, it is realestate.com of Sweden. 9 out of 10 houses sold in Sweden goes through Hemnet. It kind of looks like realestate.com 10 or 15 years ago. So really innovative business that we've been able to add to the portfolio. A couple of things have rolled out as well. We've sold out of Caring, Roku, Airbnb, and Alphabet. In the essence of time, I won't dwell on that too much. Alphabet's been a company that we've owned since 2014. It's been a tremendous company, still is a tremendous company. The growth rates aren't what we want, it is maturing. The way to think about Alphabet is, to steal a quote from Warren Buffett, we've smoked the cigar, we'll leave the butt for the others to enjoy later. The structural themes, we like to diversify our portfolio between these 12 structural themes. It is a very concentrated portfolio. We've got 22, 23 names. But then when we break it up by business segment on EBITDA, you can see that there's 61 individual businesses within this very concentrated portfolio, further diversifying the risk out in our minds. You've heard about it all day today. You're probably going to hear about it for the next 10 years. So unfortunately for you, you're going to hear about it some more again. So AI and machine learning is kind of coming in 4 buckets in our mind. The first part is selling the hardware to the cloud computer providers, which are monetizing already. The next part looks really exciting, and we're starting to see these software tiers in our hands. We're able to use them and get efficiency gains from it. And the really exciting part is what we're only just starting to see now, is real use cases where we're able to have devices or products with AI and machine learning in them right now. Which brings us to Tesla, everyone's favorite topic, it seems. So this is a video of a Tesla car coming off the production line and delivering itself to its new owner. This is happening right now. You can jump online, you can order your Tesla in the US, and within certain bounds, your car will drive itself to you. This is full self-driving, up and running in action right now. Now, their robo-taxis is also starting to launch in Austin and Texas. And this is a really exciting piece of technology that we've been waiting for, and it's starting to come through. Why we're really excited about the robo-taxi, Teslas can get these robo-cabs on the road for about $25,000 or thereabouts. And they reckon their cost per mile is anywhere from 20 to 50 cents per mile. Now, Waymo's been in the market for a very long time, and they're doing great in geofenced area with LiDAR cars. Their cars cost over $150,000 to produce. They're doing 300,000 rides per week, but their cost is the same as an Uber or a taxi. It's $5 to $6 per mile. So we know that there is a market there, but in our mind, the Waymo is way more expensive. Yes, there's a bit of life in this room yet. So we're really excited about Tesla's full self-driving. It's here, it is actually working, and the RoboCab is up and running and should scale up into the end of the year. AI and machine learning is effectively an inflection point now. If you're familiar with the Turing test, if you can have a conversation with a computer and you can't tell that it's a computer, it passes that. And what we're starting to see is these language models are pretty much there. And we're also starting to see AI photos. It's very hard to have an understanding of, are they AI generated or are they real photos? And even today, like in the news, there was an influencer that was an AI generated influencer and fooled tens of thousands of people. I guess the Darwin Awards are revolving in time with that. But what we're really trying to say here with the Hyperion portfolios is you're getting about an 80% exposure to AI and machine learning, organically driven in the fund. We've invested in these businesses because they are brilliant, but through innovation, they're starting to step into the AI space that are making these businesses much, much better, and hopefully getting those premium revenue streams to roll through. Now our portfolio, we always talk about the internal rate of return. It's the pink shaded area here. It's currently at around 21% per annum, forecasted over the next 10 years. Historically, it's sat at around 19% per annum. And that's really backed up by the earnings per share growth that this portfolio has been able to generate. Historically, since 2014, when we launched the fund, just a little over 11 years now, we've run at around 22% per annum. We're forecasting 23% per annum. In fact, at the end of, over the last 12 months, we've had EPS growth of 28%, which has driven the terminal value up by about 32% over the last 12 months. So we're not just guessing, we're actually seeing these earnings per share growth come through the portfolio and drive real value to our investors. Why do we keep talking about earnings per share? You've heard it from a lot of guys from today. When we look down and break down the returns of our fund, it's not multiple expansion or contraction in the red. It's not dividends that makes up a bit of the benchmark. It's earnings per share. Earnings per share growth is the real driver of returns on stock markets and in our portfolio indeed. Our track record's been great since inception in 2014. If you are, as I said earlier, worried about some of the uncertainty that's been through, have a look at our 5-year number. The last 5 years have been pretty crazy in anyone's measure. We've been able to generate some really strong returns for our investors who are indeed your clients. We always like to say, to be an investor, you must believe in a better tomorrow. And that's really basically saying you need to be optimistic. If you're not optimistic, turn over the back of the booklet and ask yourself a simple question: are you okay? We've heard a lot from people, a lot of information from a lot of people today, but I'd like to take 3 things away for the Hyperion presentation. We are leveraged to innovation, we are leveraged to stronger earnings per share growth, and we're leveraged towards optimism. Join us on this journey towards alpha, and you'd be proud to know if you are an investor in the Hyperion funds already, thank you. If not, we've recently purchased a bucket load of tasers for the Pinnacle sales team. So they're here to electrify you into our fund. Thanks a lot, guys.